And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Today on Financial Fitness Friday, it's tips and tricks. Not tips and tricks from Sylvester, but for the IRS. Rich Rosso. I am here with Matt Damon.
Good morning.
Matt Damon Doyle here with us this morning, and we thank you for being with us today. Larry Smith is watching Columbo, one of my favorite shows. Just one more thing about the tips and tricks from the IRS. Listen, you need a lot of tips and a lot of tricks to deal with the trap. Oh, well, I say they're traps, but there are tricks too.
Tricky traps.
Tricky traps. Lots of T's. I will tell you, Apple is setting the tone for this morning. It is a revenue machine. As service revenue hit a record $26.3 billion, growing 14% year over year. Double-digit growth. That was possibly one of the smartest things Apple had done years ago, Matt, was to start to say, how do we annuitize this business? And even though iPhone revenue was respectful, $69.1 billion, it is that service revenue, as well as Mac revenue, but that service revenue is really amazing. And they're printing cash, $29.9 billion. And I have a feeling if Matt had $29.9 billion in his cash account today, he would not be here.
They would send out a search party. Where'd that guy go?
And they'd never find you with that kind of money. And they'd never find you. So obviously it's turning out to be a pretty decent January. And everybody talks about the January market effect. Woo, January. So goes January. So goes the rest of the year. You know, the guy, the investment advisor or banker who created this, Cindy Wachtel, this was in 1942. In a published paper that smaller stocks, which typically traded in lower volumes than large company stocks, tended to rise and outperform their larger peers. So we can thank him for the beginning of this discussion of the January effect. And then there was more research in 1976 that did confirm that. So we have seen that small cap stocks tend to rally in January. I don't know if that's the case this year, and I'm not really much for these seasonal anomalies, but I thought you would like this tip with your breakfast meal, whatever that may be, Larry. So it's amazing how we try to connect all the dots in the market so that we can see where they go. Right, Matt?
Yeah, I mean, you just end up with a paper full of lines all over the place and nothing really makes sense.
And then after a while, the anomaly sort of everybody finds out about it, and then it's definitely off the table. But so we are definitely setting out to be a pretty good January. Obviously, we are going to see more volatility. We might have more tariffs coming. We have to take a look at that. That's looking towards tariffs, I think, on Canada and Mexico. But who knows? We have a day to see what happens there. So this is supposed to be the first wave of tariffs that will be unleashed. The Kraken of tariffs tomorrow. And again, Canada and Mexico, the two biggest buyers of U.S. goods. So you go ahead and make of that what you want. But we also have, Ed Gein is back. Looks like Ed's back from his spree. Nice to see you, Ed. We're always going to be nice to Ed because we don't want him showing up at our doorstep anytime soon. Really, for sure. We don't want that. That would not be very good. Yes, so today is a big number. We are waiting PCE inflation data. And obviously, based on what Powell is saying, we're looking at the forecast to be up 2.6% in December from a year earlier. So there is absolutely no reason to lower rates and time for this addiction that the market has over the Fed to cease. Okay? Now, eventually, we will be heading towards their goal of 2%. We are seeing inflation come down. But again, there is absolutely no reason where you are with prices to go ahead and lower rates. And obviously, that's what the market wants. So you are forcing the market to reshift focus away from the drug dealer of the Fed to news like earnings and things that matter for now. Unless this PCE inflation data is hotter than expected. You know, sometimes, Matt, I know we don't like inflation at our kitchen table, but sometimes inflation is not a bad thing if it gives companies pricing power, thus helps earnings, right? It's all this delicate balance of what is it that causes enough inflation for margins but doesn't cause grief for consumers.
Yeah. Well, I mean, you know, you talk about drugs. I like to say we were drunk on easy money for, 20, 30 years.
Addiction of some form, right?
But, I mean, just general economic theory, inflation is good for people in debt. And boy, does America have a lot of debt. So, you can borrow at today's money and pay it off tomorrow for cheaper dollars. And that's sort of the way it works. It's painful. And maybe we got some catch up to do on the inflation side. I don't know.
At least where the Fed is going to be much more watchful to see where we are. We have to see where owner equivalent rents come in. Obviously, they've been sticky, but they have been heading down. That would be a big help. So Ed Gein wants to know what core PCE report will signal a positive move up in the market. I guess he can't buy or sharpen his blades if inflation is too hot. I think if you're in line, Ed, sir, we don't want to tick you off, that the market will be okay with it. If it's hotter, obviously that's not going to be good. And if it comes in below trend, then obviously the market will love it because it's feeling rather positively happy in the animal spirits this morning. Oh, no, they are opting for cremation, Ed said. I can't keep inventory. Well, it looks like Ed's business is growing. At least he's
diversifying
not,
his portfolio.
Yeah, at least he's not bleeding money. That's a good thing. I don't know. It scares me. So I guess, the other thing we got to be clear of, and this is this is where I think the volatility is going to come in, is this tariff on, tariff off, wax on, tariff off kind of thing that we see that creates a little bit of turmoil. So that's just the way the administration rolls. Mm-hmm. I think the market has sort of been doing a good job riding the waves, but I think the last thing we want to see are tariffs on any of these on these countries. So hopefully that gets rectified, and we still have plenty of time for Mr. Trump to change his mind, because he can do that every minute of the day. And we'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you thought retirement income was just stocks and bonds, let us help you understand how to rethink your approach. Our first Candid Coffee of 2025 has everything you wanted to know about income in retirement. Saturday, February 8th with Richard Rosso and Danny Ratliff. What else is there besides stocks and bonds? Is your retirement paycheck really diversified? Everything you wanted to know about income in retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And we're back. I guess, Ed, if PCE comes in hotter than expected, you'll be crying like Selena Gomez in a corner, like a little girl. The market will be crying. A PCE was too hot. My stocks are going down. That's what I think would happen. Speaking of crying, the U.S. tax code has many provisions that can cause you to cry. Now, some provisions are adjusted for inflation and some aren't. It's just like pixie dust. You just never know where they're going to grace, which bracket, what matters for indexing. And again, the issue that you're always going to have is you're still going to be paying taxes, and the inflation rate that's provided is no big deal. So obviously, you have inflation-adjusted tax brackets for 2025 for single and married filing jointly that are going to go up slightly. Listen, we'll take it. Anything helps. So, again, your capital gains tax rates, your adjusted tax brackets, those go up by the rate of inflation. And then again, we are still have our due dates for quarterly estimated payments for 2025, April 15th, June 16th, September 15th, January 15th. Listen, a lot of this stuff is the same. The one thing we got to keep in mind is you also have self-employment income taxes for Social Security tax, right? Your maximum wages, that threshold is $176,100, up from $168,600. Standard deductions for 2025. Your standard deduction, and most use standard deduction, is going from $29,200 for joint filers to a whopping $30,000 for married filing jointly. Unless you are age 65 plus, then you get yourself $1,600 a piece more. Again, no big thrill. I think when it comes to taxes, Matt, that is an ongoing process, and inflation-adjusted numbers are not always going to matter. because regardless of what they are, you are going to try to do your best to be as tax efficient as possible, right? I think one of the best things the IRS did, and I will tell you, it took a while because we would scramble by the end of the year, and you're going to understand that when I say this, is remember the qualified charitable distributions? Mm-hmm. Donors 70 and a half and older can benefit if they make these qualified charitable distributions or QCDs directly from their traditional IRAs to charities, right? We used to wait with sweaty palms like Selena Gomez until until the IRS finally finalized, can we do it this year, right? But that has wound up, I think, being one of the most effective moves we have seen. We have a lot of clients that will go ahead, and again, these are not maybe clients that have, of course, millions of dollars in their IRAs and hefty RMDs. These are rather normal accounts, and people feel compelled to provide to charity. And this just seems like an easy way to do it, right?
Yeah, I mean, it's one of the most efficient ways. As the tax code changes, I think, a great example is in terms of deducting advisor fees, right? You used to get a tier 2 deduction for that. And any fees that you would pay a firm like ours or another advisory firm, you'd get an itemized deduction for that. They took that away. So there was a time before that when, we would recommend to clients, well, let's pay your IRA fees out of a taxable account. And then they took that deduction away. And now we say, okay, well, let's go ahead and bill the IRA because at least you're paying your fee with pre-tax money. So it's sort of the same line of thinking with giving money to charity. Mm-hmm. You're not getting the charitable deduction anymore because all of those rules have changed. And, even though the standard deduction is, sort of a de minimis increase, at least it's an increase.
Exactly.
But most people are taking the standard because itemizing just doesn't make sense anymore.
Right.
So now you're going to just take your RMD to the extent that you can if you don't need it, and just never touches your top line. It just doesn't hit your 1040. So, you just push that out to whatever charity inclinations you might have. And it's a great way to support the community, and be involved with other folks.
Absolutely. So that usually is capped at $100,000 for QCDs. Now for 2025, it is $108,000. You've got to be very careful on how you do it as well. You do not take a distribution and send it to your charity. You allow your custodian to go ahead and cut the checks directly to the qualified charity. And that is done through your advisor, your broker. The custodians have a really good system in place, and it's expeditious. They understand that more people do this. So it's not that difficult. Now, I do have clients, you might too, Matt, who have multiple ways to donate. They have multiple charities, right? So they want to give $3,000 to one, $2,500 to another. Well, you need to have a separate form for each, but they don't mind, and we don't mind, because it does give everybody the opportunity to go ahead and help out, like you said, Matt, their favorite charity and their community, and allows them to do that, and makes it easy.
Yeah, and as we talked about on a prior show, but touching back to that as a reminder, one great tool to use if you have multiple charities or you just don't want to give, say, for example, you want to take, your $100,000 and get the full benefit of that this year for your taxes, but you don't want to give that full gift to those particular charities all at once. A great tool to use is a donor advised fund, right? So you can use that. Again, we like Fidelity as our primary custodian. So, you'll have an account on your Fidelity login that says charitable account. And, at your pleasure, you can go in and, this year give some more next year and parcel that money out over a period of time. So there's options and other ways to do that as well.
Absolutely. So this chat is really, I'm glad the IRS isn't on the chat this morning. Because they'd be like, whoa, red flag, red flag, red flag, red flag. you just, when you come up with your quarterly tax payments, you're not just willy-nilly coming up with a number. You guess the amount you'll owe and then pay it later, because you could have underpayment of estimated tax. And that applies to individuals, estates, trusts, right? If you don't pay enough of estimated tax on your income. So you really want to work with your tax advisor to make sure that you are doing the right thing, because it's 5% of the amount due. Sometimes your tax advisor can go to bat for you and say, hey, well, it's a little late. But listen, you don't want to do it. So when you're making your estimated taxes, make sure you're working with your tax person. I work with my tax advisor. I know exactly what I need to do every quarter based on last year's income. Now, if my last year's income is going to be substantially higher, right, then maybe I'm going to even look at, or I know this year's is going to be substantially higher than last. I'm going to readjust because my withholding or my quarterly payment, because I know I could get hit with an underpayment penalty.
Yeah,
and I do not want to do that.
Yeah, I mean, there's, as far as the penalty goes, I believe there's 3 exemptions that the IRS grants for, if you get the number wrong. One of which is paying whatever you paid last year. I think one of which is if you pay 90%,
at least
90% of whatever is due this year. And then I think there's some de minimis feature. It's either 1,000 or 5,000. I can't recall exactly, but there's a third caveat there. The other thing also to remember, if you are running into this and you are eligible to take money out of your IRA, or you need to, and you're not employed, if you're at RMD age and you need to take money out of your IRA, any withholding that is done through a custodian like Fidelity, if you say, I'm going to take my IRA distribution but hold out 50% or 100% of all that money, those monies are considered as paid in all year. So it's in addition to, whatever your quarterlies are, but it'll give you a sort of a buffer, because IRS timing on that isn't when those quarterly payments are due. That whole amount is basically looked at like payroll or W-2 type taxes as paid in throughout the year. So there's multiple ways to protect yourself if you're concerned from a quarterly tax standpoint. But let's not forget also, when we're talking about deadlines for those out there with independent trusts, right, we're running into the next deadline is going to be for 663B. The IRS allows trusts, and this is basically because of foreign tax credits, or foreign taxes rather. Those usually aren't known or declared immediately, so it's hard to meet a 12/31 deadline. But you have, I believe it's 65 days, so that puts you somewhere in March 5th, 8th, somewhere around there, where you can take a distribution out of a trust, out of a grantor trust. You can take a distribution out that qualifies for the prior year. So when you're trying to do those 1099s or those K1s that those trusts are issuing when those 1041s are due, you have that leeway to go in and sort of backdate a distribution. So I think that's the next deadline, Rich, coming up.
We're going to talk about this too, because you have some super duper catch-up contributions if you're in your 60s for your retirement accounts, your employer accounts. We want to talk about that when we get back. Stay tuned.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
If you thought retirement income was just stocks and bonds, let us help you understand how to rethink your approach. Our first Candid Coffee of 2025 has everything you wanted to know about income in retirement. Saturday, February 8th with Richard Rosso and Danny Ratliff. What else is there besides stocks and bonds? Is your retirement paycheck really diversified? Everything you wanted to know about income in retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
One thing that the consumer confidence measures, is that correct if I say consumer confidence measures?
Measured squared.
How many measures can the consumer confidence measure? I don't know.
The Real Investment Show podcast.
Dr. Seuss.
The consumer confidence measures investor sentiment about stocks. That's the highest level on record.
Same show, your schedule.
It's amazing. Consumers are super confident about the stock market.
At realinvestmentadvice.com.
At the same time, they go, my life sucks economically, but the stock market, it's all good.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Larry on the chat's talking about how he doesn't really worry about his taxes. I don't think Larry has paid taxes since Sanford and Son first premiered on TV.
I can hear the bugle in my head.
But I got a solution for all this. Ed Gein, I'm going to send you over Larry Smith's address. I don't expect to see him on the chat next week. Now, somebody asked about the unreimbursed medical and dental expenses deductible deduction, and that is still there. But they have to exceed 7.5% of the filer's adjusted gross income, and the filer itemizes on Schedule A. It used to be 10%, but it is 7.5%. Okay. Oh, yeah. Yes. Oh, we got to promote something. Sorry. Ed, sharpen your blades while we do this. We are going to be having a Candid Coffee on February 8th. Retirement income. Everything you wanted to know. Listen, retirement income, sometimes you got to be creative. It's not just this, oh, I'm just going to withdraw 4% from my stocks and my bonds. Oh, la, 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 la. No. You have to look at Social Security. Do you need some form of secured income? Do you have rental real estate? What else are you doing out there? You working part-time? What exactly? Or how do people today cobble together a retirement income, or what I like to say, the lifeblood of retirement? And so we're going to be talking about that and, of course, taking your questions. Register below or today at realinvestmentadvice.com. That's realinvestmentadvice.com. So this is a live stream webinar. So before, Ed, you get out there for your daily antics and create mayhem, 8 a.m. Central, you can 8 to 9, give the victims a chance to have breakfast. Then get out there.
Ed might be on a second course at that point in the day. I have a feeling Ed's up early.
Yeah, me too. Me too. So then we have, of course, you have $7,000 for your traditional IRA and Roth IRA contributions. That's up to $7,000 plus $1,000 for savers age 50 and older, right? So you got to be careful with Roth because you could phase out completely. Now, I did have a client yesterday who maxes out his 401k and said, Rich, I'm thinking about putting money in my traditional IRA. Can I do that? And I'm like, sure. But why would you want to do it? Because one, you do not have deductible contributions. So you are making these contributions. And by the way, this is an individual who phases out of Roth. So there's no Roth decision for him. But he's a super saver and likes to save. But we talked about this yesterday, and I think it's something important to bring up today. You, by all means, if you max out your 401k and you want to make traditional IRA contributions, God bless you, go ahead and do it. Here's your problem. You are funding that, most likely, your traditional IRA with after-tax dollars. So you might say to yourself, hey, Matt, you have an IRA rollover from a previous employer, so I don't want a separate account, or, I just don't want to. So I'm going to go ahead and contribute that after-tax money into my IRA rollover. What do you think that does?
Yeah, I mean, just like everything with the government, it's, ultimately they're not going to take any responsibility. So you've got to keep up with that accounting. You've got to know where all of that flow is. And I mean, it becomes a nightmare just to keep track of. So
that's right.
That's an administrative nightmare that, if you want to go have fun and do fishing while you're in retirement instead of sitting at a spreadsheet, don't do that.
Exactly. Because what you're doing is you are mixing pre-tax, post-tax, and when that pre-tax, now the government would love for you to do this, by the way. So Matt and I don't want you to do it, but the government says, yes, please do it. Because if I'm doing it with after-tax dollars and now I'm taking a distribution, most likely I'm going to get taxed on that money again because I have not kept track. And I have just put the cream in the coffee and I cannot extract it. So what did I suggest to this client yesterday? If you decide, first thing I would do, first of all, is to see if your employer is going to do the super duper contributions, catch-ups that you can make, right? Age 60 to 63, the additional catch-up contribution is $11,250. That's pretty good, right? So that's what I would see first. But you know what, Matt? I'm working with clients now, and I tell them about the super duper additional catch-up, and they're within the age range, and they're not able to do it because their plan sponsor says, we're not worried about that right now.
Yeah.
Right? So I said, ask about that. If not that, can you make after-tax contributions to your 401k? Most likely he can't, but if he decides that he wants to make a traditional IRA contribution, we would set up a separate traditional IRA account so we know any contributions that go into that account have been funded with after-tax dollars. Oh, I have to set up another account. Listen, it's better to do that. Mm-hmm. if you want to do it. So I'll be supportive of it if you set up the separate account.
Keep that pocket separate.
But I don't think a lot of people would do that. I think they would just say, hey, I just want to put it in my IRA rollover. And somehow, yes, I filed Form 8606, but I'm never going to remember that. So right?
Well, yeah. I mean, most folks want simplicity in retirement. So, you know, you just forget. And all of a sudden you're going from, 20 accounts to 5. And oh boy, there was that, $13,000 account over there on the side that I just would like to have my life easier. And, that's as you call it, the cream in the coffee situation. You're just not getting it back out.
Mm-hmm. So keep that in mind. Now, your 2025 regular contribution limits, $23,500 if you're under 50 years old. That's fine. That's great, right? Your total contribution limit is $70,000, right? Plus $7,500 for savers age 50 and older. That total contribution limit is salary deferral and employer contribution, right? So if you're self-employed, you might do both. So you have a solo 401k. Health savings accounts, right? Danny's favorite account. I think I heard him say to Mrs. Ratliff, if someone would increase the HSA contribution, it was either you being married to you or increasing my contribution. Poor Michelle would be packing her bags today. He's that much in love with the health savings account.
Oh, boy.
He's not cheating with anybody else, only an account. So you could save pre-tax dollars in your HSA, right? And then you withdraw them tax-free to cover. For 2025, your contributions are $4,300 for self only, but $8,550 per family coverage plus $1,000 for age 55 and older. And Matt, what do we always say for people who make these HSA contributions? Don't touch them. Let them grow. Pay your medical expenses from after tax or your emergency reserve. Treat that like a health care 401k account.
Yeah. I mean, there's no requirement that money be spent or money be taken out, I should say, of that account as the expenses happen. Mm-hmm. So if you incur an expense this year or next year, there's no rule that says you can't reimburse yourself 20 years from now.
Right.
And, you can get a lot of money out of those accounts at that time. The limits are so low, it's best to let them percolate, let those funds grow for the longest period of time if you're able to do it.
If you're able to do that.
Yeah.
It's not chump change, right? Over time, you're making those max contributions, triple tax-free. You could use that money, of course, as we talk about retirement income, there's something called the retirement spending smile, where people, in their active years, they spend a lot of money and then it sort of valleys out. I call it the big valley, but that's the actual smile. And then the other side of that smile is higher healthcare expenses in retirement, right? Additional out-of-pocket costs, above and beyond Medicare, all these different things that you might need. And wouldn't it be nice if you could do that completely tax-free and maybe avoid or minimize your taxation on your Social Security benefits? And you have usually the ability, a lot of great HSA custodians out there, to allocate that money among various mutual funds. In other words, you can go create an asset allocation within your HSA. They'll usually leave about $1,000 in cash just in case you decide, but for the most part, you can invest that money.
Mm-hmm.
So I think it's a great account, and like I said, we have to send Danny to therapy in case they increase that limit to like 18 grand. I don't know what's going to happen. You might lose it.
Mrs. Danny might be calling up Ed for some pointers.
Yeah. Listen, Ed, this is Danny. We're keeping the HSA, but we're unleashing the Michelle. How do we do it? We'll continue this discussion when we get back. Shh, Ed, between us. That's just between us. And there's probably about 4 people listening, so them too. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you thought retirement income was just stocks and bonds, let us help you understand how to rethink your approach. Our first Candid Coffee of 2025 has everything you wanted to know about income in retirement. Saturday, February 8th with Richard Rosso and Danny Ratliff. What else is there besides stocks and bonds? Is your retirement paycheck really diversified? Everything you wanted to know about income in retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So TS on our chat says, why are people smiling about higher costs in retirement? And Shop's Law answered, appropriately, it's the shape of the spending curve. It sort of is. When you first retire, that's usually a more active element of your retirement. It's one side of your smile, right? You are spending more, you're traveling, whatever it may be.
Checking off those bucket list items.
Yeah, checking them off. Checking off those buckets. I have clients that do that. They're traveling. I live through them. Oh, you're going on a cruise where? Oh, I've never been. I barely leave the office or I barely stop working. But I live in through you, and I'm glad you're able to do it. I love hearing all those active year stories. They make me happy that people are enjoying their retirement, and I'm interested in hearing about all the great things they're doing, not only with themselves, but with their kids and their grandkids. It's very cool. And I always get this, Matt, I'm sure you do. How did I ever work?
Right.
Right? So that's that part of the smile. And then you go down, cross the smile like the bow, and that is where your spending is sort of leveling off. I have clients that are mid-70s to sort of mid-80s that they're not spending more money. They're not traveling as much. They're healthy.
Been there, done that.
Been there, done that. Maybe they're traveling a little bit more local. They've taken up different hobbies. And then as they age, of course, we start to see healthcare expenses start to increase. And that is the other side of your smile. It's very rare, and I have clients that have been in distribution mode for about 23 years. It's very rare for someone to call you every year and say, can you please inflation adjust my distribution?
Right.
It doesn't happen that way because your spending doesn't do that.
No.
You don't keep up those active year spending, that active year spending throughout. Some years you'll take some more, but many years will go by where you're just in the groove and you're not spending as much. You're not eating out as much, right, Matt? People are like, or we go local or, it's just different. Again, it's not that it's a bad part of retirement. It's just more settled and I don't need to go to Italy and I don't need to travel here or there. I'm very settled, very happy with my life.
Yeah, I think,
how-
most times I've found that clients get into kind of a stair-step mode of distribution. So, they'll 3 or 4 years will go along and they're getting whatever it is, a month or a quarter or however they like to get their distributions, and they'll get those to their checking account and they'll be fine. And then 2 or 3 years will go by and they'll say, well, look, my savings account's going down in value. I want to increase my distribution. And then we stair-step it up for another 3 or 4 years. It's not usually, hey, can you increase my distribution per month by 3%?
Right.
That's not that's not what usually happens.
And just some advice, if someone is approaching you with a stair-step smile, run. That's probably Ed in his mask. So like Texas Chainsaw Massacre mask. No stair-step smile, run. But yes, in other words, it's not as clean as far as spending goes. You need to understand spending habits and then apply them to your plan realistically as to how you're probably going to spend. But not only that, we are depending upon the experience we have with many other clients who I call are in Wilson mode. Cross the fence, tool time. And they are in a different type of groove. Now, since, to your point about the stair step, Matt, since we have clients that have experienced inflation a little bit more acutely, they have said, listen, hey, I need some more bandwidth in the spending. Can we increase it? Yeah, based on where your benchmark rate's been and based on how the performance of the portfolio's been, absolutely. What are we looking at? So some are looking for a little bit more breathing room and increasing their cash flow. But that's the point. Your portfolio is living, breathing. Your withdrawal rate is living, breathing. It needs to be monitored. It needs to change based on market conditions. You just don't retire, go into a 20-80 portfolio where 20% stocks, 80% bonds, never make a change, and you stick to the same old rule. Your plan needs to be made flexible because you're living, breathing. Your life changes. So does your plan. So do conditions change, right? And I've been doing a lot of, and I've spoken to this on the show before, goal scooping with clients. Hey, you needed to buy a car next year? Based on your benchmark return and where you are now and based on what you spent, can you do it this year? How about that renovation to your kitchen or your bath? You were thinking about doing it in a couple of years. You're going to do it anyway. This is the year. Give yourself a raise. Give yourself a bonus. Obviously, we consider taxes and other things, but for the most part, we're pulling some of that money out of the cash well outside of the investments, and then we're going to replenish that bucket. So that's that goal scooping kind of thing, Matt.
Right.
Where we're accelerating the checkoff list of some of the goals that people have to make some changes or make some purchases or take some trips that they've wanted to do.
Sure.
Because we don't know, and Lance wrote a great piece called Curb Your Enthusiasm, which you definitely should look that up at realinvestmentadvice.com. Take a look at Michael and Lance's articles. But you just can't expect to have a year like last year. It would be great, but last year our trading signals were few and far between and mostly around the positions because, as I tell clients or advise them, we put corrals around these conditions that run, and we want to either contain them or let them go, right? So, but a wholesale, we need to make some big changes on the ranch. That doesn't happen or didn't happen last year. So we don't know with this year, just based on this transition from all the government stimulus we had to the private sector, that handoff might be a little sloppy, thus more volatility. So we may not have the same kind of year that we did last year, right? So the unfortunate part is if you depend upon variable assets only for your income, you have to consistently be aware of what your spending rate is over time. If I have taken my Social Security properly and I have some form of pension or guaranteed income that at least covers my non-variable or fixed expenses, I understand. But if I have to curtail my spending on the variable side, as far as taking less out of my stock and bond portfolio, it's not going to affect my lifestyle. I don't know if you remember, Matt, but during the COVID era, there were all these articles coming out from people I respect greatly, like Wade Fowle, a lot of retirement incomes, David Blanchett, that maybe the 4% portfolio withdrawal rule is closer to 1.8%. Now, put that in practice as an advisor. You're telling your client that they could have $10,000 a year or $2,000 a year. Wait, what?
Right.
That's a big difference, right? I always say it's very difficult to take a fixed portfolio withdrawal from assets that go up and down. That doesn't make sense.
Right. And if you're going to do that, or at least have a large piece of your retirement puzzle in a variable type of structure, at least here internally, when we're doing projections, we tried to err on the side of being conservative about that rather than aggressive. I mean, I can remember, and I'm sure, Rich, you had a similar experience, but I can remember some annuity wholesaler guy coming when I was, fresh in the business when I was 20 years old. And I said, well, he's showing me this great, illustration, and the line moves from the bottom left corner to the right corner, and this person's going to be a gazillionaire. And it's, well, what's your return assumptions? Oh, we run those at 12 to 14%. Really? Yeah.
Life is good.
Yeah. Well, and you don't have to worry about anything 12 to 14%. I'm going to retire with all the money.
And listen, if you're using historical returns in your financial plan, you're pretty much getting the same advice without the annuity.
Right.
Oh, sure. Yeah. So we look at forward-looking returns. We calculate them out. We use a valuation trigger to lower them or increase them. So keep that in mind. I don't know why I think I'm Larry in the future. I don't want to travel. He's a curmudgeon. And I'm getting there.
The future?
Yeah. I'm going to get myself I Am Larry Smith shirt.
Time traveler.
Where they... Why travel? Lots of people. Never a good time to travel. I mean, that sounds just like me.
Yeah.
Well, it's just tough to travel sometimes.
I don't know. I don't see you sitting on a porch in a rocking chair.
I won't do that.
Yeah.
I won't do that. But I'm not a big, if I never travel outside of the United States, I would like to see Italy. But if I never travel out, I don't feel like I'm going to miss anything. Like, I feel like I want to see more of the U.S. first. Mm-hmm. And I love, as Brent and I talk about, all the different places in Texas. My girlfriend's born in Texas, but I know more Texas history than she does. This doesn't seem right. What kind of schooling did she get? I'd like to know. Look at Larry. I don't want to go anywhere. Larry is doubling down on his curmudgeon-y today. Larry, you're my soulmate. I bet he's sitting there in his rocking chair. He's all shriveled up. Listen,
warm him out today.
I'll catch you on the CB radio, Larry, on the way out. Ed, you've been missing. God bless you. All I'm going to say is I hope you all have a great weekend. Lance back on Monday. That's where the sanity, unfortunately, enters the studio.
Returns.
Yes. Thank you, Matt, for being here with us today.
Thanks for having me.
You all be great. Stay safe.